This is Alan Bush with the daily financial forecast for Thursday, July 7th. Stock index futures starting out just a little bit lower in the overnight trade. However, we did see some recovery and now higher prices with two economic reports coming in better than expected. That's the automatic data processing report showing a better than expected employment change, at least according to their figures. Also, we had the jobless claims showing a larger than expected decline. And we did have energy prices firming, so all of that supporting stock index futures across the board. Longer term, we feel that the main trend is higher for all of the major stock index futures. In fact, global indices are likely to work higher, especially in the UK, where most of the stimulus that we are anticipating will likely to come first. But major central banks around the world are now put in a position where they have to, I believe, add more stimulus to their economies in light of the Brexit outcome. So stock index futures still appear to be headed higher, and this is a very long-term trend. Moving over to the currencies, seeing the dollar index a little bit higher earlier, a little bit lower now, some offsetting influences. Looks like some flight to quality influences being mitigated by a rising pound. Also, we did have the two economic reports today, a little bit bullish for the dollar, so some offsetting influences there. The pound able to firm, but it looks like just short covering in advance of the U.S. employment reports that are due tomorrow. Still thinking longer term that the pound will probably drift lower as the Bank of England is forced to add more stimulus to its economy, and more stimulus means lower interest rates. Lower interest rates means a weaker British pound. Now moving over to the interest rate futures markets. Yesterday we did see some new highs for the move in the 30-year Treasury bonds. This coinciding with record low yields for the 30-year Treasury issues. However, today a little selling coming in, possibly some long liquidation at the long end of the curve in advance of the employment numbers tomorrow. Also, the probability of a rate increase at the July Fed meeting now just 6%. That was basically the same as yesterday. Also, some analysts are predicting that there will be, of course, no increase in interest rates this year from the Fed, potentially no increase in 2017. And some analysts now thinking that the first rate increase has been pushed off now until the first quarter of 2018. So a Fed that is very slow, we believe, to raise rates is a supportive factor for the Treasuries, and we would expect Treasury futures markets to continue to drift higher. Also in the precious metals, some selling today, which looks like profit taking. Our view remains the same. Any breaks should be used as a buying opportunity in gold and silver, and ultimately it will be increasing inflation globally that sustains the bull market in both gold and silver. So good trading, everyone. Once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.